When you need stability and security in your investment portfolio, especially as you approach or are in retirement, you have more and often better options than just CDs and high yield savings accounts. A multi-year guaranteed annuity, MYGA for short, might make more sense for you. Here's everything you need to know coming up. Welcome back to the best financial minds on YouTube. And for those of you who don't know me, my name is Steven Spicer, and as I've helped hundreds of clients in and through retirement, I'm often surprised by how many just have their hard-earned assets sitting mostly in a high-yield savings account or some CDs. Often there are better ways, better options out there. I'm talking higher returns than those options without sacrificing the security. MYGAs are one of these options. So what exactly is a multi-year guaranteed annuity? It's a type of fixed deferred annuity, meaning there will be a fixed guaranteed rate of return for a predetermined period, typically ranging from 3 to 9 years. This helps protect against market fluctuations. It's allowed to grow tax deferred and can provide a guaranteed income during retirement. To purchase a MYGA, you enter into a contract with an insurance company, similar to how you would a CD with a bank. You select a single premium amount that aligns with your financial goals and needs. The minimum and maximum contribution limits vary by provider. In return, the insurance company guarantees a fixed interest rate on your contribution for the duration of your chosen term. Interest is credited regularly. At the end of your term, you have several options. 1, you can select another multi-year term. If securing a guaranteed interest rate for another set period aligns with your financial goals, you can renew for a new MYGA term, either the same or a different duration, if available, with the same or a different MYGA provider, if there's a different one that is now more competitive. A good financial advisor should be helping you sort through all of this, all of your options each time. The interest rate for the new term will be based on the rates offered at the time of renewal. Again, it's similar to CDs, but in general, higher. 2, you can transfer to a fixed account. Some MYGAs automatically transfer the accumulated value into a fixed account with a 1-year renewable interest rate if no action is taken at the term's end. This allows you to retain flexibility while deciding your next steps. 3, you can choose a settlement option. If you choose to elect a settlement option, you can convert your MYGA into guaranteed annuity payments, either for life or for a specified period, providing a steady income stream. 4, you can just surrender the contract and access the funds. If a MYGA no longer aligns with your financial strategy, you can withdraw the accumulated value at the end of the term without surrender charges. You may take the funds as a lump sum or through partial withdrawals. In short, it's very similar to the way a CD works, except that settlement option, which comes from the fact that it is an annuity, which is what allows for the tax-deferred growth. So we want that. Let's compare the pros and cons of MYGAs. First, the benefits. Number 1, guaranteed rate of return. A MYGA provides a fixed guaranteed interest rate for the duration of the contract, ensuring a predictable return on your investment, similar to a certificate of deposit, a CD. The exact rate will vary based on the economy, but they're typically higher than what you could realize from a savings account, especially when you lock them in over longer periods of time. 2, protection from market volatility. MYGAs are insulated from market fluctuations as their rates are locked in for a specified term, offering stability compared to other investments. 3, tax-deferred growth. Like other annuities, MYGAs allow your earnings to grow tax-deferred until withdrawal, helping you maximize returns over time. And now the risks. The first is limited liquidity. Annuities often impose penalties for early withdrawals or surrendering the contract, restricting access to these funds without incurring charges. So it's important to ensure that you're doing this with amounts that make sense for your unique financial situation, in the same way that you should if you determine to put some of your funds into a CD, for example. 2, potentially lower returns. Although MYGAs typically offer higher returns than you might find with other fixed rate vehicles like CDs and especially savings accounts, they tend to realize lower returns compared to investments like stocks or mutual funds during most years. Of course, investments like those also risk significant drops, which are often unacceptable during sound retirement planning. Anyway, 3. Fees and expenses. Annuities come with costs such as surrender charges and administrative fees, although the returns that we've expressed here and that will be expressed are usually after net of those fees. Some MYGAs also include a market value adjustment, MVA, which can positively or negatively impact your accumulated value if you surrender the contract or make withdrawals beyond the allowed amount during the surrender charge period. In general, those charges, fees, or adjustments only apply if you're choosing to withdraw your funds before the predetermined length of the contract, i.e., you enter a 3-year MYGA contract and then decide to withdraw all your funds after just 2 years. That's where you'll run into those surrender charges and the variability that can come from the MVA, which I'll explain further here in a second. 4. Inflation risk. MYGAs provide a fixed rate of return, which may not keep pace with inflation, potentially eroding purchasing power over time. But again, usually less inflation risk than CDs or savings accounts. 5. Not FDIC insured. Unlike bank deposits, annuities are not federally insured. Their guarantees rely on the financial strength of the issuing insurance company. And to ensure security, evaluate the company's stability by reviewing ratings from agencies like AM Best, Fitch, Moody's, or Standard & Poor's. That being said, states generally offer a state annuity guarantee, of which the exact amount will vary by state. Hopefully that gives you a pretty good idea of the overarching pros and cons of MYGAs. So let's look at how MYGA withdrawals work. Some MYGAs offer the flexibility of penalty-free withdrawals during the contract period. While terms vary by contract and insurer, many allow you to withdraw a specific percentage of your annuity's accumulated value annually without incurring a surrender charge, sometimes referred to as a free surrender or a penalty-free withdrawal. However, withdrawals beyond this limit before the contract term ends typically result in fees or penalties, which can range from 1% to 10%. When evaluating the withdrawal terms of your MYGA, pay attention to 2 key features: market value adjustments, MVAs, and return of premium, ROP. These provisions determine how your funds are managed in scenarios involving early withdrawals or surrender. Regarding the MVA, if your MYGA includes a market value adjustment, MVA provision, withdrawing funds before the term ends can result in an adjustment to your surrender value based on interest rate changes. If interest rates have risen since you purchased the annuity, your surrender value may decrease to reflect the higher rate environment. Conversely, if interest rates have fallen, your surrender value may increase. The MVA provision helps the insurance company mitigate potential losses from early withdrawals, which can be a good thing because this risk management feature enables the company to offer a higher guaranteed interest rate in your contract, as long as you hold it for the duration and the terms agreed upon, as it retains the ability, the insurance company retains the ability to adjust values in response to shifts in interest rates. Again, remember, the MVA only applies for early withdrawals, those that would be within that surrender/penalty window. After your contract period is up, the MVA does not apply. The return of premium, ROP feature, allows you to recover your original premium payments if you surrender the annuity under specific conditions. This feature can be appealing if you're concerned about needing access to your full investment in case of an emergency. However, MYGAs with an ROP feature often come with lower guaranteed interest rates to balance the insurer's risk of refunding the premium. Obviously, we're always balancing some degree on that risk-reward spectrum. It's important to note that not all MYGAs include an ROP or an MVA provision. The availability of these features, along with their terms and conditions, varies by insurer and contract. The most direct comparison for MYGAs with which people are most familiar, as I've already pointed out, are CDs. Unlike insurance products, certificates of deposit, CDs, are banking products, but both provide guaranteed fixed interest rate options and are reliable choices for secure returns. However, there are key differences between the two, all of which we've touched on, but I've consolidated that direct comparison for you here to help you as you're planning for your future. Here are the 4 key differences. 1. MYGAs tend to offer higher interest rates. While both MYGAs and CDs guarantee fixed rates of return, MYGAs often provide higher interest rates than CDs, making them a potentially more lucrative option for mid to long-term growth. The second comparison is their tax treatment. MYGAs grow tax deferred, meaning you don't have to pay income tax on the earnings until you withdraw them. This allows your earnings to compound over time. In contrast, CD interest is taxed as income annually, unless the CD is held in a tax-advantaged account like an IRA. This regular taxation can limit its compounding potential. The third comparison is the issuers. MYGAs are issued by insurance companies, whereas CDs are issued by banks and credit unions. And the fourth comparison is their early withdrawal penalties. Both products impose penalties for early withdrawals, which can affect liquidity. MYGAs may involve surrender charges that could impact both your interest and principal if withdrawn early. With CDs, early withdrawals usually result in losing a portion of the interest earned, but the principal amount is typically preserved. So for whom does a MYGA make the most sense? Their conservative nature often makes them especially appealing for those nearing or already in retirement. However, they may not be the right fit for everyone. A MYGA could be a good fit for you if, 1, you want to lock in a guaranteed interest rate for a specific period, 2, you prefer protection from market volatility and potential losses, 3, you value tax-deferred earnings growth, and 4, you might be interested in the flexibility to choose a settlement option that provides a lifetime guaranteed income stream. As with any financial product, it's essential to thoroughly review the terms and conditions and consult a financial advisor. This will help ensure the MYGA aligns with your individual financial goals and long-term needs. If this is a path you're considering, you'll want to find a financial advisor who will not just help you find the best rates today, you want someone who will help you going forward as well. Because as these come up for renewal, they often just auto-roll into the same vehicle. And auto-rolling into the same vehicle and term is usually not in your best interest. And unless you want to keep up with all of this yourself, it helps to have someone on your team ready to help you evaluate all your options over the years. Honestly, I used to hate pretty much all annuities, but now I understand where the different types can fit in a well-balanced financial plan designed for true financial freedom. I break that all down for you in this video. I'll see you there. Take care.